All right. Today is Wednesday, April 21st, and this is a recap for the stock market activities today. We continue to observe corporate earnings, and so far the theme is, regardless of how good earnings are, stocks are not reacting very positively, and we still have the most important batch of earnings coming up in the next few weeks. But perhaps from the earnings we got so far, there are few themes. Number one, companies pointing out the increase of input costs due to the rise in inflation, at least from Procter & Gamble and Coca-Cola. We also saw two contrasts between Goldman Sachs earnings and Netflix yesterday. One stock has been on a tear since the beginning of the year with reasonable valuations, but it has been rallying impulsively higher. So the expectations were extremely high. Goldman delivered and then some, and therefore we saw a positive stock reaction after earnings. Then we have the contrast. Not quite, but there is a point to make here. Netflix has been consolidating in a range for almost a year now, not doing anything at all. We know that the valuation is a little bit generous for Netflix, not as much as some of the mania names in the market. However, earnings did not live to expectations, even though the numbers are not awful for Netflix. Matter of fact, it was an okay report, and they have announced a $5 billion repurchasing program for shares. Yet the stock went down over 10% overnight. What does that tell us about the upcoming earnings, specifically from big cap technology stocks? Because if these stocks blast higher after earnings, the entire market will rally along with them. But if they bomb, then the entire market will go down with them. For example, let's take a look at a name like Amazon. The expectations are that Amazon will produce phenomenal numbers, and the reason is the stock is pretty much trading at all-time highs. However, as we saw with the Netflix, the stay-at-home trend, the benefits from the stay-at-home trends is starting to fade away. You saw the subscribers growth declining and not meeting expectations. Likewise, in a name like Amazon, I showed you a chart a couple of days ago pointing out that consumers are spending more at brick-and-mortar businesses rather than Amazon in areas that have already reopened, meaning that perhaps the prices of stocks like Amazon, I'm just giving you an example. You can choose Apple, Microsoft, whatever you want, but Amazon in this case, will the earnings live up to expectations and where the price is trading right now, or will earnings confirm that the consumer is moving away from the stay-at-home habits to the reopening habits? And perhaps the heydays of earnings growth for Amazon, at least for this short period of time, will hit the rocks. These are the kind of things we have to look out for and anticipate in the upcoming batch of corporate earnings. We will also talk about cryptos, but specifically Bitcoin, because we have the head of Guggenheim saying that Bitcoin will crash over 50%. And it is not looking good for Bitcoin here because the technicals are starting to reverse to look bearish. Furthermore, we have a lot of concerns about China and cryptos, specifically Bitcoin. At what angle will the Federal Reserve, the Treasury Department, and perhaps the Justice Department come after Bitcoin? We talked about the environmental concerns, but now we have concerns regarding the relationship between China and Bitcoin, and I have all the details for you. In addition, we will talk about Tesla versus China. The honeymoon period between China and Tesla seems to be over, and China is turning against Tesla. We will cover that and a lot more, but for now, let's start by covering how the market performed today. And here we go. The Dow Industrial Average closing in the green by 316 points, or a gain of 0.93%. The Nasdaq closing in the green by 163.95 points, or a gain of 1.19%. The S&P 500 closing in the green, 38.48 points, or a gain of 0.93%. The volume remains shy, specifically for the Nasdaq. And today the activities were pretty much 180 of what happened yesterday, a reversal of the exact same picture that we had yesterday. What about the sector's performance for the day? Leading the pack at number 1 and capturing the gold medal, materials. At number 2 for the silver, healthcare. And watch out for the silent rally in healthcare. Healthcare has been the underperformer for the year so far. So will we see the healthcare sector catching a bid? That is the question. and earnings will confirm investor sentiment regarding healthcare. And at number 3 for the bronze, consumer cyclicals. The only laggard for the day, the utilities sector closing in the red. What about the advance to decline ratio for the New York Stock Exchange? 83 advancing versus 16% declining, a decisive day to the upside. Once again, a 180 for the image we saw yesterday. What about the Nasdaq? Also 81% advancing versus 17% declining, a decisive day to the upside. This might be confusing for investors. Yesterday we had a decisive day to the downside. Today we are seeing a reversal, a decisive day to the upside. So you have to look at the charts, specifically the longer term charts, to make up your mind, because trading day to day is a recipe for disaster in this calm before the storm period. Moving on to futures. What's going on here? Crude oil declining big, down by over 2% for both the WTI and Brent oil. What about softs? Lumber looked a little shaky overnight, but as I told you, the dips will be bought aggressively in lumber. Lumber finishing up in the green, so did OJ, cotton, coca, and sugar futures. Coffee futures also in the green, but a little muted. Moving on to metals. What's going on here? Gold, silver, platinum, copper, palladium, all closing in the green. Gold and silver are appreciating the muted activities in the 10-year Treasury yield. Furthermore, copper is sensing a weakness in the US dollar and it continues to rally higher. And we have palladium hitting all-time highs. And I made a prediction last year that palladium will hit all-time highs due to the demand for catalytic converters. And here it is, a few months later, palladium hitting all-time highs. And it is one of the reasons behind my investment in the Russian ETF, because Russia happens to be the largest producer of palladium. Now, what are the implications for the rise in palladium futures on auto manufacturers? Not so good. And we will hear from General Motors and Ford in the next coming weeks from their earnings report, and I bet that they will mention the extra input cost that they have to deal with. Now, passing the extra input cost to customers is another story. It is easier for Procter & Gamble and Coca-Cola to pass the extra cost to the end customer, not so easy for car manufacturers because they have to stay competitive in the market. What about meats? Down day for meats, whether we're talking about lean hogs, feeder cattle, live cattle futures, all registering big declines today. What about grains? The only laggard, soybean oil and soybean oil futures, have been on a tear. So taking a break here, along with corn, muted activities for corn, but big gains for canola, oats, rough rice, wheat, soybean meal, and soybeans futures. Moving on to the big casino, the options market, and here are the performances today. Eerily quiet in the casino today. The option remains very muted, even for Apple, the hottest stock in the options market, trading below 1 million contracts. Matter of fact, just a little over 950,000 contracts, about 68.5% of those were calls. And again, I am anticipating a reversal in Apple. And as Apple goes, so will the Nasdaq. With a little over 500,000 contracts, about 58% of those were calls. At number 3, NEO. With about 500,000 contracts, about 69% of those were calls. And we are finally seeing a rebound for names like NEO, Palantir. Can we celebrate? Finally, 1 day out of 100, Palantir finally rebounds. Along with other mania names, by the way, the likes of Plug Power and Blink Charging, etc. What about the unusual trades taking place in the options market today? Let's start with the ticker TRQ. This is a Canadian copper miner. So this is a bearish bid against copper by buying the 16 puts, expiration date June 18th, with expectations that the name will drop over 13%. They paid about 80 cents a piece to enter this trade. All in all, bringing the total to about $1.6 million. What about the ticker GM for General Motors? Here we have a bullish bet by buying the 63 calls, expiration date May 21st, with expectations that the name will rise over 9.5% by then. They paid about 83 cents a piece to enter this trade, all in all bringing the total to about $1.2 million. What about the trade for the ticker WB for Weibo? Another bullish bet here by buying the 56 calls, expiration date May 21st, with expectations that the name will rise over 13%. They paid about $1.25 a piece to enter this trade, all in all, bringing the total to about $1.6 million. What about the trade for the ticker triple BY, Bed Bath & Beyond? They're making a bullish bet here by buying the 30 calls expiration date June 18th. With expectations that the name will rise over 13.5% by then, and they were willing to pay $1.45 a piece to enter this trade, all in all, bringing the total to about $1.1 million. What about the ticker SHOP for Shopify? Another bullish bet here. It is a short-term one, by the way, expiring this Friday for the 1,200 calls, and they are expecting Shopify to rise over 5% by then. They paid about $2.45 a piece to enter this trade, which brought the total all the way to $900,000. Lastly, we have a spread trade here for the IWM small caps. They bought the 189 puts and they sold the 167 puts with the expiration date of July 16th. They are expecting the IWM to decline over 15% by then, but not more than 25%. They paid $2.50 for the long leg, and they collected $1 for the short leg. All in all, the entry cost for this trade was $1.50, and that brought the total all the way to about $500,000. I do like the trade, and I did follow this one because the entry cost is small, yet the potential for reward is large. And looking at the chart of the IWM, it's starting to look a little shaky. The IWM depends on a lot of reopening stocks. These reopening stocks are heading into earnings season very heavily bloated, trading above pre-pandemic highs. Even if earnings come out impressive, some of these stocks will drop big. That would be an opportunity to buy, but regardless, they will do a number on the IWM. Moving on to the headlines that shape the day, starting with macro news. Let's talk about the budget deficit and government spending because it has reached comical levels. The Treasury Department said spending rose 161% last month year over year, while receipts only increased 13% year over year. How the hell do you suppose we're gonna pay for all of this spending? For now, the printing machine, but that is only sustainable for a short amount of time. You're not gonna be able to sustain wide budget deficits for a long period of time. What does that mean? It means that taxes will go higher across the board. Continue to ignore all you want, but when you have companies complaining about margins and inflation and the rise of input costs, add to that increase in corporate taxes, and what do you say? Great entry point, bro, for the market, right? You get two massive headwinds facing the market. Number one, the rise of inflation. Number two, the upcoming increase of corporate taxes. And they can say, oh, it's going to be 28%. That's not going to be enough. They can keep that for a few years, a couple of years perhaps, and the result of all of this generous spending from the federal government, stimmies after stimmies after stimmies, programs after programs after programs, guess what? The Democrats will win again, and they will open a wider lead in the Senate and Congress. Next time around, corporate taxes are not going to stop at 28%. They're going back to 35%. But hey, Papa Jerome got the magic wand, the tools. He's going to fix everything. Put your blindfold on and continue to buy. Here is Papa Jerome. And by the way, does this guy even work? He gives interviews pretty much every single day. His job is just to give interviews. And here we have an interview with Jerome Powell, the Fed chairman, with Reuters. And perhaps this is a little hint for you. For the current confusion state that the Federal Reserve, specifically Jerome Powell, is going through. Fed chairman says he won't allow substantial overshoot of inflation target. Now, we know that the inflation target is 2%. But when Powell says he won't allow an overshoot over the inflation target, what do you mean by that, Mr. Powell? Do you mean 2.5%, 3%, 4%, 5%? Because you say that you are targeting an average 2% inflation rate. Now, we had this deflationary period for a long time, meaning that if you want to average 2%, you're going to have to let inflation run very hot, perhaps 3%, 4%, even 5% for a little while. And that will be destructive for the stock market. And therefore, Jerome is saying, hey, I will not allow an overshoot, but he's not giving any specifics. Matter of fact, Jerome Powell says that the framework of averaging 2% is not following any mathematical formula, meaning that we will just eyeball inflation. And Jerome is playing this game, these mind tricks, because had he given us a formula, the market expectations will be precise. And if the market is expecting tapering at a precise point, then the market will react decisively to the downside. But keeping that door open by being vague and not following any formula gives Jerome Powell the flexibility and the illusion of control that he believes he got. Meaning, let's say that inflation rises all the way to 2.8% and companies start to complain, prices go higher across the board, the stock market starts to throw a fit. All of a sudden, the Fed Chairman Powell will say, okay, I'm going to taper now. Wait a minute, Mr. Powell, you said you want to average 2% inflation. Yeah, we already averaged 2% inflation according to my eyeballs. He wants to keep this flexibility. And in turn, Powell will stab a lot of investors in the back out of the blue. But perhaps Powell can breathe a sigh of relief, because he has an ally for now. That ally is the UAE, the United Arab Emirates. And the reason is the UAE is buying an insane amount of bonds. Matter of fact, exceeding China for now to the tune of $17 billion. And for now, that gives Jerome Powell a break, because the 10-year Treasury yield is stabilizing below 1.6%. But once these planned purchases are done, what happens next? Once again, the calm before the storm. More in macro news. You know, when I talk about UBI, the future of this country with high unemployment and high inflation, a housing crisis where people are going to live in capsules, government provided capsules, and they will have digital wallets, I'm not really exaggerating, because UBI is already happening. Matter of fact, we have many cities in the United States right now, major cities, already implementing one form or another of UBI. What do you do when you print all of this money out of thin air, creating inflation, including wage inflation, and that speeds up the automation of a lot of jobs, in addition to a lot of jobs that will not be recovered to begin with, because corporations figured out from the COVID-19 crisis that they can do more with less. They can be more efficient. Therefore, you're going to push inflation higher, increasing poverty higher, because housing prices will not be accessible to the majority of population. And you're going to have a huge chunk of the population being unemployed. The future is UBI, MMT, modern monetary theory. And of course, the deflationary camp, inflation deniers will say, oh, but MMT is bad. No. You say that the money supply doesn't matter. It doesn't create inflation. So you should be a believer in MMT, UBI, digital wallets, capsules, because who cares? Print the money out of thin air and you're not going to get inflation anyways. We might as well cancel taxes, not just rent. You know, cancel rent. How about we cancel taxes too while we're at it? Moving on to market sentiment news. We talked about the contrast between expectations versus earnings. You could have phenomenal earnings but bad valuations, and therefore you see stocks reacting negatively. We don't have the full picture yet, but from the earnings we received so far, the picture is very clear. Priced in ? Stocks, the top estimates are falling during this earnings season. When did we see that last, by the way? Q1 2018, if you're old enough to remember. Because we had the tax relief rally, the massive rally, right after the Trump elections. And corporate earnings came out very impressive. Yet stocks continued to sell off and crash even after very impressive earnings reports. Beats, top line, bottom line, didn't matter. And the reason is, it is priced in already. The question is, we know that with all of the stimmies, corporate earnings are expected to be phenomenal this season. But is that already priced in? The $1 million question. Many companies are turning in stronger than expected quarterly earnings, but that is doing nothing to boost their stock prices. In fact, the 67 S&P 500 companies that have beaten bottom line earnings this reporting season have actually averaged a one-day drop of 0.62% following the release. That is a far cry from the long-term average gain of 1.86% following earnings beats in the last 15 years. It shows that the bar is particularly high for earnings to lift stocks higher. after an impressive rally to record highs this year. Many argued that much of the good news on the corporate earnings side has already been priced into the market. More in market sentiment. You know, the bros keep telling me that I'm a doom and gloom and a bear or whatever. You've been saying this, you've been saying that, and the market continues to go on and on and on, higher and higher and higher. It's exactly the same sentiment, word for word, that we heard back in 1999. You bears keep saying that the market is going to crash, yada, yada, yada. But stocks continue to go higher, and what you guys don't understand is that the internet is the future, bro. You gotta buy Cisco, you gotta buy all of these .com companies. That's the future. You shouldn't be betting against the future. What do you know? We had the biggest crash in the market since the Great Depression. And many of these companies, these .com companies, disappeared forever. Some of the companies, even the big ones, the likes of Cisco and Intel, have never recovered the highs of the .com bubble. We're not saying that you cannot play the market, but play intelligently. Play knowing that this is a rare, extreme orgy of a bubble that will not last, and it will end up in a massive market crash and a reversion to the mean. Part of playing the market intelligently is buying stocks, investing in stocks with good balance sheets, solid earnings, solid growth, and solid fundamentals. But most importantly, solid valuations. Of course, this description cannot be said on the biggest scam played during this bubble, the SPAC mania. You know, during the .com bubble, Warren Buffett, the greatest investor of all time, was mocked that his style of investing is outdated and he does not understand technology and the .com boom, yada, yada, yada. Buffett remained silent. He did not comment. He did not respond. He continued to do what he does best, buying solid companies. And when the crash happened, flushing out the retail participation out of the market, Warren Buffett came out and said, "I told you so." And he said, the problem with this kind of investing is that people are investing in companies that are designed to make money off investors, not for them. This description could not be more accurate for SPACs. They are designed to make money off investors, not for them. And now we're seeing the SPAC massacre. All the donkeys, the morons, the Robin Hoodites, and the likes who've been worshipping the cult leaders, the SPAC maniacs, the likes of Chamath, Palate Potato Tequila, the biggest scammer of 2020, the biggest scammer right after Elon Musk. Trust the process, bro. Here is the process. The 25 largest holdings in the SPAC ETF are down an average of 44% from their 52-week highs. 44%. Once again, scam vehicles designed to make money off investors, not for them. What do you expect going to happen? And you see the scam boom, that's a Freudian slip, the SPAC boom peaking earlier this year and now severely underperforming the market. And SPACs are now under investigation from the SEC. SPACs should be illegal. These are criminal, racketeering vehicles to exploit the weakness and the lack of awareness from the retail investors and traders' side. SPAC Jesus, the scammer, the criminal, walks out with millions of dollars, but investors and believers in SPACs walk out losing half of their investment so far. More in market sentiment. Here is the bull's favorite indicator, the CAP-E ratio, reaching the highest reading since the .com bubble. Look at the chart and tell me that this is a good entry point, bro. With a straight face, of course. More indicators. What about the advance to decline ratio? While the advance to decline ratio remains healthy for the New York Stock Exchange, it is starting to look terrible for the Nasdaq. And when we see those negative divergences in the advance to decline ratio, it is usually preceding a correction. More in market sentiment. What about the Dogecoin mania? Here's another one that will meet the same fate of SPACs, Nikola, and the other scams in the market. But this time is different. But Dogecoin is the people's coin. Okay, have at it. Dogecoin boom is a retail phenomenon driven by Powell giving money to everybody. And this is, by the way, from Novogratz, who is one of the biggest bulls on cryptos. But even Novogratz is saying this is an extreme mania driven by extreme risk taking by retail investors, just like we saw with GameStop and the likes. And what's driving the mania is the irresponsible monetary policy. Now, I disagree with Novogratz about his positioning for cryptos, but I have a lot of respect for him for being candid. And here we have Scott Minerd, the boss of Guggenheim, and he is issuing a dire warning, saying that Bitcoin will plunge 50% near term because things are getting very frothy. Now, in the past, Scott made predictions and calls for Bitcoin that it will crash, etc. And Bitcoin continued to rise higher and higher. Eventually, Mr. Minerd will be correct and Bitcoin will crash. But perhaps this time around, the boss of Guggenheim is speaking with a lot of conviction. Why is that? Because there are insiders in Bitcoin and Wall Street firms who know that there is an upcoming siege by the government against Bitcoin. JP Morgan warns of Bitcoin weakness as futures get liquidated. Who is liquidating their Bitcoin positioning, by the way? I'll tell you who. Insiders who already know that there is something very bad from the regulatory side that's about to hit the crypto market, and specifically Bitcoin. It is a threat to the establishment, that's for sure. They're going to take it down. Bitcoin bears are stalking crypto prices. Here is how low they could go. And we already talked about that. We're talking about 50% declines for Bitcoin. The question is, what will be the angle from which the government will attack Bitcoin? Here it is: national security and climate change. Peter Thiel warned that Bitcoin is being used by China to undermine the US dollar and the stance of the United States in general. And by the way, Peter Thiel is not a bear on cryptos or Bitcoin. He's just telling the truth. China's Bitcoin mining is threatening its climate change targets. Mining cryptos and Bitcoin is a nasty, dirty business. If it continues to grow, it will produce more negative impacts for the environment and the climate than big oil. So that is one angle, the climate change argument against Bitcoin. The other argument is, and perhaps this is the strongest one from a national security perspective, it seems that China has the bulk of control over Bitcoin, specifically when it comes to mining. And this is the big bomb, by the way. We saw Bitcoin crashing over the weekend because an outage in China, specifically the Xinjiang region. The United States is turning up the heat against China due to the practices going on in the Xinjiang region, accusing China of using slave labor and banning the imports of cotton from Xinjiang. Now, if cryptos, specifically in this case Bitcoin, is being mined and resourced in Xinjiang, then you bet your ass that the US government will ban Bitcoin next. Here it is from Fortune magazine. How much Bitcoin comes from dirty coal? A flooded mine in China just spotlighted the issue, and insiders are liquidating their positions based on this news. The recent accident showed just how fragile and how environmentally damaging the Bitcoin supply chain can be. One of the great Bitcoin unknowns has long been the amounts being produced or quote-unquote mined in what's believed to be the top locale for mining the signature cryptocurrency, China's remote region, Xinjiang. We got the answer when an immense coal mine in Xinjiang flooded and shut down over the weekend of April 17 to 18th. The blackout halted no less than 1/3 of all Bitcoin's global computing power. We'd seen estimates that high, but this shutdown confirms them. Bingo, they're coming for you. They're coming for you. The cryptomaniacs, watch out. We also learned that the area in Xinjiang where all that mining happens is much smaller than previously believed. It underscores China's dominance in Bitcoin mining, and that dominance raises big security concerns. The Xinjiang accident highlights that Bitcoin is a creature of fossil fuels, principally coal, the dirtiest of them all. Its rise is even providing a lifeline for the fading natural gas industry in the US. Miners from New York State to Kentucky are repurposing obsolete facilities to supply the cheap power they cherish. That Bitcoin spreads a carbon footprint bigger than Australia's, that the run-up in its price could triple the carbon dioxide dioxide it spews. So far, it doesn't seem to bother the famous, otherwise green enthusiasts feeding the craze from Elon Musk to Gwyneth Paltrow. Now, we know that Elon Musk is an asshole. He cares about nothing but himself and his ego. But when it comes to Gwyneth Paltrow, she's a nice person, but perhaps she's not aware, because she pretends to be a woke person, by the way, perhaps she's not aware of the damage to the environment Bitcoin mining does. Perhaps she's not aware of the slave labor issue in Xinjiang involved in mining and powering cryptocurrencies. And now, all of a sudden, China is warming up to Bitcoin once again. China's central banks is now referring to Bitcoin as quote-unquote investment alternative, making a significant change in the rhetoric. But Pomp tells me Bitcoin is the future, bro. Watch how bad you're gonna get slaughtered, because the government is coming for Bitcoin 1,000,000%. If that's not enough, governments all over the world are planning to issue their own digital currencies. This as more countries join China in pursuing digital currencies that could challenge the US dollar, including the UK, with hopes for Bitcoin. Get it? Britcoin. My question is, will Britcoin includes the face of Prince Harry, the crybaby that he is? Moving on to corporate-specific news, starting with, you guessed it, Tesla, Le Souffle. Experts worry that the name of Tesla's quote-unquote full self-driving feature implies a greater functionality than what the company is actually offering, but the risks of it don't appear to be holding Tesla back from a broad beta release of the feature. Now, the family of the victims will sue Tesla, that's for sure. They want to juice up some cash out of Tesla. But so will the federal authorities, by the way. And they do have a case if indeed the self-driving was activated in this vehicle. Because, number one, the name fully self-driving, full self-driving, FSD, the F part is problematic, because from a legal perspective, they will argue that yes, Tesla issues all these warnings, that you have to have your seatbelt on, you should have your hands on the steering wheel, you cannot go to the back seat and kick back and relax while the car is driving, because the program is experimental. It is not perfect, and Tesla drivers are the lab rats, sending data back to Tesla. So if you have a Tesla and you're driving with the FSD program, you better start asking Reverend Elon Musk to pay you in cash or stock, because you're working for him, you're sending all of that information for him to perfect his program. But once again, back to the legal argument, the F part will be problematic for this case, specifically for Tesla. Furthermore, Elon Musk has been hyping the FSD program on Twitter and social media, Joe Rogan, etc., giving drivers the illusion that the program, the autopilot, is indeed fully capable of self-driving. When you give the audience the illusion that the program is pretty much perfect and fully trustworthy, when the reality is on the contrary. Now you stuck your neck out from a legal perspective. So this will be a very long case, a complicated case against Tesla, and one day it will be a case study in the Harvard School of Business, by the way. But the troubles for the souffle isn't just about the crash over in Texas, but it is also due to the rift between Tesla and China. The honeymoon period between Tesla and China seems to be over, and the Chinese authorities are now attacking Tesla, calling it by name, forcing Tesla to apologize to the CCP and the Chinese people. And we all saw the images from the Shanghai Auto Show with the woman standing on top of the Tesla vehicle, yelling and screaming, saying that the autopilot program killed her father, who owned a Tesla.
Katrina, how did this escalate then so quickly, so suddenly for Tesla?
Yes, well, as you said, it all began when an angry protester jumped on one of their display cars at this big auto show, and she was shouting that the brakes in her Tesla had failed, almost killing her and her family. And this outbreak happened to be captured by many spectators and subsequently went viral, which was a big embarrassment for Tesla, particularly at such a high-profile event. And then the reaction, basically, well, China's state-run Xinhua news agency published an article that said the quality of Tesla's electric cars must meet market expectations. And then a few hours later, the Communist Party itself weighed in, saying that the automaker should really respect Chinese consumers and comply with local laws and regulations.
Okay, Katrina, They had a bit of a honeymoon period here after they opened their Shanghai factory very quickly. Indeed, is the bigger picture that the mood amongst customers in China is turning sour on Tesla? I mean, I still see plenty of these vehicles whenever I travel, whether it's in Beijing or Shanghai or Shenzhen.
Yeah, look, I mean, that's true. Tesla is still by far and away the number one selling EV in China by a big margin. But I do think it's fair to say that we are sort of seeing a shift in tone. Even though, as I said, they're very popular, this is coming at a time when there's a lot of competition from local startups like NIO. That's really intensifying. And just over the last few months, it seems that Tesla's been just called out more frequently over defects in its cars. So I would say that's a fair assessment that the tone or the honeymoon period may be coming to an end.
Now, we know China. You cannot go in a public platform like the Shanghai Auto Show without a prior approval from the CCP, meaning that the CCP allowed this woman to demonstrate and they intended for the video to go viral. China, for now, is not banning Teslas, but they are turning the heat on Tesla, playing bad cop. And the message is, Elon Musk, don't you ever think that you will get to the Chinese market and dominate this market without bowing down to the rules and the obligations you owe the CCP, the Chinese market, and the Chinese consumer. Oh, and by the way, other rivals, NIO, Xpeng, already eating Tesla's lunch in China. This is a ramp up for nationalism in China against Tesla. The message is for the Chinese consumer, choose Chinese-produced EVs, stay away from Teslas. China doesn't want to ban Tesla, kick them out of the country, because China has grievances saying to the US and the EU and other markets, look, you guys ban our products from your quote-unquote free market. But in China, we allow your products. So they don't want to tarnish this image. Instead, they're using propaganda against Tesla to drive the Chinese customer away. And I know that the culties are going to say, oh, but Tesla's a monopoly, bro. But Reverend Elon Musk is the smartest man alive. Here comes the competition, your monopoly. Mary Barra of General Motors will hit you with a baseball bat on the head. The 2023 Cadillac Lyriq is already announced with the price tag, meaning these are not just hopes and dreams. These are real, solid products that will hit the market. The competition is about to be ramped up significantly. And as you can see, beautiful pictures for this product from Cadillac. And by the way, Cadillac Super Cruise is now superior to Tesla's Autopilot, at least according to Motor Trend. General Motors and LG plan to build a new $2.3 billion plant to build batteries for electric vehicles, a key step toward the US automakers' goal of an all-electric future. But Kathy Wood says GM will never catch up to Tesla. But it is a monopoly, bro. Here is your monopoly. Toyota, the most reliable auto manufacturer in the world, is now turning up the heat, announcing over a dozen planned EV vehicles, including here in North America.
Toyota says it's ready for the EV race. Let's get to Phil LeBeau now with a special guest. Hi, Phil.
Hey, Joe. Let's bring in Bob Carter. He is the VP of Sales for Toyota North America on a very important day. As the Shanghai Auto Show is going on, Bob, you guys are essentially worldwide saying, here we come when it comes to electric vehicles. Let's talk about the concept that you unveiled overnight. This is the BZ4X. What's the idea here, and when might we see this here in the United States?
Well, Phil, thank you. It's great to have global auto shows back in course after the pandemic. But the BZ4X will be the first vehicle of our sub-brand, BZ, which means Beyond Zero. But we're entering the full BEV market with both brands. A month ago, we also announced a product for our Lexus division. So we will have two full BEVs on the market here in the U.S. in 2022.
Moving on to the heat map analysis. The picture today is the exact opposite of yesterday. Yesterday, the heat map was pretty much all red with very few exceptions, and we talked about these exceptions specifically related to earnings. Today, it's 180. The roulette table is pretty much all green with very few red exceptions, meaning that if you placed a bet anywhere on the table, you scored today. The exceptions were due to earnings in the case of Netflix, and then we have downgrades for Oracle, Spotify, NextEra Energy also down. All of these names down about 3% or so. And then we have Peloton. Peloton down about 6%. Peloton has its own problems. We talked about that a few videos ago with the video of the child being swallowed by the treadmill machine. But all in all, everything pretty much green, no problems whatsoever. Reopening, reinflationary, deflationary, stayed home, didn't matter. However, there is a noticeable weakness, or shall we say underperformance, from the big cap technology stocks. We're talking about Apple, we're talking about Google, Facebook, Microsoft, perhaps an empathy to what happened in Netflix. You saw the same reaction for Disney, for example. If we are seeing weakness in the streaming trend for Netflix, perhaps Disney is the one to follow. Yet you saw names like Viacom and Discovery rebounding significantly higher. So perhaps the market is saying Netflix already pricing in the streaming premium. Disney already pricing in the streaming premium. Different story for Viacom and Discovery. These names are down big since the explosion of Archegos Capital. So perhaps we need to reprice the streaming premium in these names. Furthermore, we're going to hear from Credit Suisse, and if they indicate that the liquidation is over, then that will be another tailwind for Viacom and Discovery stocks to rise higher. What about the different themes in the market? Starting with the reopening trade, green across the board. With sizable gains, we saw significant weakness yesterday. Today, we're seeing significant strength. And the reason is we will go back and forth before earnings. You will see liquidations, de-risking prior to earnings, but you will also see an appetite for exposure prior to earnings, specifically from the options market, buying calls, creating mini gamma squeezes here and there. So we'll go back and forth in a choppy action prior to earnings. And therefore, you have to study the charts for each individual name and have a longer term perspective, longer than 3 minutes. You know, all of you who are sitting all day in front of the screen, watching the market tick by tick with a big jar of lotion next to you, jerking off. You gotta have somewhat of a longer term perspective. At least a week, for example. Moving on to the inflationary trade, also green across the board, with exception for UPS. Now, I would love to see a sell-off in these names after earnings, meaning they report excellent earnings, but once again, perhaps the valuations and the stock price action went a little too far, and we see a decline in these names after earnings. That will be an opportunity to buy if earnings are solid, but the price action is negative, because the macroeconomics tailwinds for these names remain intact. And I am talking about names like Martin Marietta, Alcoa, Hubble, John Deere, Waste Management. I'd love to see a sell-off in these names. What about the disinflationary trade? Mixed picture, some losses here and there. We talked about Peloton. It has its own circumstances, but we also saw positive price action for names like Nvidia, Okta, Tesla, ServiceNow. And once again, the market's not paying attention to the U.S. Treasury yields right now. The market is paying attention to earnings. You're seeing the fluctuation of positioning back and forth in pretty much all the names in the market. Moving on to the charts analysis. Starting with the SPY 30 minutes chart. We talked yesterday about the bear flag formation. We had one playing to the downside, and we had another one that turned out to be a false bear flag from a 30 minutes perspective. We also talked about the imminent crossing in the MACD indicator from a 30 minutes perspective, not just for the SPY, but for the Qs, the IWM, and I was expecting that we will see a gap higher in the morning. We did not see that. Matter of fact, we saw a gap lower, at least in the Nasdaq. But quickly, that crossing in the MACD took place, and you saw the SPY, the Qs, the IWM surging higher. The question is, did we see a cup and handle formation, and that is already playing out? And if it is playing out, what is the destination? We do have a gap that we left pretty much at all-time highs. We can go all the way there and then decide on the direction of the next move. However, this is once again a 30 minutes perspective. It is insignificant. You have to follow the daily chart, specifically the futures contract. And when we do that, what do we see? We see that the SPY futures reversed the negative move from yesterday. However, when we look at the indicators, we are still overbought from an RSI perspective, and from the MACD perspective, it is just a matter of time before we have a big crossing to the downside registering red impressions in the histogram. That will indicate a momentum to the downside, perhaps going all the way to 3,960. Now that we're seeing a pickup in volume, I highly doubt that the SPY will continue to rally impulsively higher as we saw the last few weeks during low volume, because when the volume starts to pick up higher, the resistance becomes a lot stronger. What about the Qs? 30 minutes perspective. Here's another way to look at it. You can look at it as a cup and handle. You can also look at it as a reverse head and shoulder formation that is already playing out to the upside. It was a bear flag formation yesterday, but once again, we had an imminent crossing in the MACD. I was actually expecting a gap higher. That did not happen, but the end result that I was expecting took place. And we have closed above half of the body of the pole. That takes away the bear flag formation out of the window. We have the reverse head and shoulder. It is already playing out, and we have a gap higher. That could be the destination. But for now, we also reached the levels of the prior bear flag that broke out to the downside. In this formation, you have to expect some sort of resistance, and this resistance is at or around the level of 340. So my bet is, absent of a gap higher, the Qs will struggle to pass above 340 easily. And when we zoom out to the daily chart of the Qs, the continuous contract, once again we are struggling back and forth around the level of 13,900. This is the typical behavior. When you reach this sacred level, this very important level, which happens to be the prior highs, you cannot just wall up above it and blast higher. You have to give that level the respect it deserves by going back and forth, consolidating, gathering energy, new blood, and then blasting higher. Now, that might not be the necessary outcome because we do have a negative divergence in the RSI. We do have an imminent crossing, a negative imminent crossing in the MACD indicator. We also saw Netflix being shot up. The question is, will Apple, Amazon, and Microsoft be next? And if one of those big giants fall and disappoints on earnings, then we will see the next move downward for the Qs. In this case, we are looking for 13,599. That is support number one. If that doesn't work out, we have 13,300 to look down to. Once again, I doubt that we will break higher above 13,900 without tagging a former level of support first. Moving on, the IWM. We talked about the bearish formation yesterday from a 30 minutes perspective. We indeed managed to close the gap at around the level of 218. We also had an imminent crossing in the MACD indicator from a 30 minutes perspective, and that played out to the upside. And it was a big impulsive move higher, pretty much reversing the entire move yesterday. Now the move is getting very extended in the IWM from an RSI perspective. And once again, we are talking about a 30 minutes perspective. I am identifying for you the next level of resistance at 223. My expectations are we could go all the way to 223, get rejected, and then reverse once again. And therefore, playing the market day by day, your head's going to spin so fast, you're going to start to puke because yesterday, massive move downward for the IWM due to the sell-off in the reopening trade. Today, a massive move higher in the IWM due to the reignition of the reopening trade. It's going to go back and forth until we hit the heart of earnings season. What about the RUT, the Russell 2000 daily perspective? And this is perhaps the most important chart to watch right now in the market because we are eyeing 2,264. You got to close above that from a weekly perspective to maintain any bullish outcome. Furthermore, we have a negative divergence that has to be corrected very soon. If the RUT struggles to do that by the end of the week, then the next move will be an impulsive one to the downside. And as we saw with Bitcoin, for example, reversing the negative divergence for about 3 minutes and then going back to the negative divergence in the RSI. That was a bull trap right there, giving you the illusion that Bitcoin is out of the woods, time to go long, and what do you know, over the weekend, reversing all of that move and crashing about 20% to the downside. And therefore, the longer term charts, the longer term closings are the most important. In this case, the weekly closing. Moving on to the dollar index. What do we see here? Weakness in the dollar, struggling to catch a rally from the support of 91. My target here, if the dollar continues to go down, is going all the way to the level of 90. That would be a solid level of support and a massive bounce higher, at least in the short term. The decline of the dollar, good for copper, also good for gold. But gold is more concerned about the weakness in Treasury yields. Gold loves the weakness and the muted activities in yields. And you see gold silently, slowly but surely rallying higher. And the destination here is we have 1800. That is the next level. We might face somewhat of resistance over there, but it is not a strong level of resistance. The stronger level comes at 1825. If for whatever reason we see yields blasting higher again, then gold will hit the brakes. What about Bitcoin? The chart of the day. It's not looking good here, folks. Look at the negative divergence in the RSI. You had that bull trap crossing above the negative divergence, giving everybody the illusion that Bitcoin is about to rally higher. Certainly I thought so, only to go down with even stronger conviction to the downside. And now we have a confirmation from the MACD indicator, signaling that the momentum to the downside is about to heat up significantly. We have a bear flag. We are struggling to recapture the trend line. You have bearish signals all over the place. And I am looking for the next level of support of 42,000. That will be a big decline for Bitcoin, and it will certainly make headlines and perhaps impact the broader market. And by the way, why am I suddenly turning sour on the 21st century's tulip mania when I was optimistic that the next move will be higher? Number one, look at the technicals. Not one indicator, not two, not three, but 4 indicators showing weakness in Bitcoin. Furthermore, the fundamental analysis, I just covered that during the headlines of the day segment. The concerns regarding Bitcoin and China, Xinjiang, and the climate issue, they're coming for it. They're coming for it, and insiders, the whales, who perhaps, by the way, here's a little secret for you, pumping Bitcoin on social media, these are the same people. When Bitcoin crashes, they will come out and say, oh, we took some profits, yada, yada, yada. Oh, you took profits now, huh? Moving on to yields. What's going on with the 10-year Treasury yield? Muted action, but showing bearish signals. We talked about the Bank of Japan buying a bunch of bonds earlier in the month. We talked about the UAE buying bonds also earlier this month to the tune of $17 billion. We also talked about the Federal Reserve buying over $85 billion in long-term Treasury yields in a matter of weeks, exceeding, by the way, their publicly announced goal on the New York Federal Reserve website. The tailwinds for yields to rise higher remain intact. Inflation and a potential for Chinese dumping of bonds. But for now, for the technical analysis, we do have a bearish formation that could take us all the way down to 1.5% reading on the 10-year Treasury yield. What about bond prices, the TLT? We talked about the bull flag formation, and the first target is 141. If that is beaten, the next destination is 143, and that would be a very hard, strong resistance to break above. What about the VIX? Just like we saw with the SPY reversing the move from yesterday, the VIX also doing the same thing. Up 6% yesterday, down 6% today. But all in all, the breakout of momentum to the upside, at least from the MACD indicator, remains intact. Meaning that we could see choppy action back and forth in the market, up one day, down the other. But all in all, for now, the trajectory for the VIX is higher. And if the trajectory for the VIX is higher, then the trajectory for the SPY is lower. What about Apple? As Apple goes, so will the Nasdaq. A few days ago, the Nasdaq was down, but Apple closed in the green. What does that tell you? You gotta wait for Apple to start to show some weakness before making a definitive conclusion about a reversal in the Nasdaq. For now, a 30 minutes perspective shows a bear flag formation that is supposed to play to the downside, all the way down to 131 as the first level of support. We witnessed a massive rally in Apple the last few weeks. Heading into earnings with a massive move higher, bloated momentum indicators is a recipe for disaster. Meaning, if I am a bear on Apple, I'm actually hoping that Apple will continue to rise higher and higher and higher prior to earnings, because that will be a no-brainer bet to buy put options on Apple prior to earnings, because regardless of how good earnings are, the name will crash down, correcting 5, 6, 7%. Therefore, if you are a bull on Apple, matter of fact for the market in general, you want to see a 3 to 5% correction in the broader market prior to earnings, because that will take a little bit of the air out of the bubble and make stocks head into earnings a little less bloated, therefore eliminating the risk of an excessive downward move after earnings. What about Tesla, the souffle? What's going on? Trading below support earlier in the day, but closing strong above the support, this is a very strong move, a decisive move for Tesla on the bullish side. If it happens to continue all the way till the end of the week, then we have 781.30, which is the prior gap that Tesla failed to close. And of course, if that happens, then my strategy will be prior to earnings is I'm leaning toward an iron condor, meaning that I'm betting that Tesla will not react impulsively one way or the other. I'm leaning toward that. Haven't made a decision yet, but for sure, if Tesla goes all the way, say to 800 by the end of the week, then I will sell some call spreads because that's easy money. Moving on to the conclusion of this video, and let's do some Q&A. You know, you ask me questions all the time and you think I'm ignoring you. Of course not. I'm reading all of your questions. So let's answer some of those, specifically regarding Cathie Wood's RKK, because I announced that I am opening a new short position in the RKK. Last time around, I opened a short position in the RKK was January 26th. Of course, the stock continued to go higher for a little while, a few more days, and the culties and the likes continued to say, oh, you see, your short is not working. Blah. What do you know? The stock crashed down from the point I shorted about 28%, over 30% downward move from the highs. So what do I see now? Here is a weekly perspective, and the negative divergence on the RSI is getting stronger. We have a bear flag formation that is supposed to play down, breaking the trend that started last year. When do I know that I'm wrong and close the bet? How about the level of 131? If we close above 131 from a weekly perspective, then perhaps my timing is wrong and I should take the chips off the table. When do I double down? If the chart breaks the trend in or around the level of 112, that will be a signal to double down because the RKK will start an impulsive move to the downside. Then we have another question. Why not just short specific names within the RKK versus shorting the ETF? The reason is Cathie Wood made us all a favor and she packaged all the overpriced garbage in one easy to short ETF. She continues with impulsive behavior, selling the winners to fund the losers, chasing every new shiny object. Matter of fact, there is an inner joke within Coinbase executives that goes that they're selling to Cathie Wood. They're dumping their shares to Cathie Wood. So all of this reckless behavior, she's acting like a day trader. She's eliminating good names from the portfolio. For example, Taiwan Semiconductor, that's a good name. Why eliminate this name and add new overpriced garbage? The problem with ARK Invest is the following. Their core positioning in some of the stocks is extremely high, meaning in certain names they own the majority of the stake in the stock. And there are mechanical reasons that led to the collapse and the implosion of Archegos Capital that will also lead to the collapse and the implosion of ARK Invest. We're not talking about margin calls because Cathie Wood is not gambling with margin. She's gambling with your money. She actually has tangible liquid cash to gamble with. The problem is when your core positioning in certain names is very high, what happens if we see a significant outflow out of ARK Invest ETFs? Number one, these stocks where their positions are highly concentrated will crash. And if they do crash significantly, 20, 30%, then all of a sudden ARK Invest will have to liquidate some of their other holdings, meaning that we will see a domino effect crash in ARK Invest ETFs. And therefore, I don't know which name will break first. But what I know is if whatever name breaks, then the ETF itself will start to melt down. And therefore, I am shorting the ETF, not specific names. And here is the last question of the day. You keep talking about massive inflation coming, then talk about the market being in a massive bubble. Could it be the massive inflation that is coming being priced in the market today and it looks like a bubble? Let's talk about pricing in stuff. For example, during earnings season, you hear about stocks beating earnings expectations, beating the bottom line and the top line, but somehow the stock crashes, down 5%, down 10%. Why is that? Because the stock has already priced in the good news, meaning when stocks in the market in general is trading at elevated levels, it is pricing in the good news. not the bad news. Now, if the market crashes 20, 30, 40%, then perhaps it is pricing in the bad news, and the clearest illustration for that was the year 2018. Everybody was pricing in the tax cuts, corporate tax cuts, and stocks rallied significantly higher. And then we saw the crash in January 2018. And the reason is stocks went way ahead of themselves, pricing in the impact of tax cuts and then some. And therefore, the surprise is to the downside. Now, if I told you that taxes were about to increase, then you can't say that the market is already pricing in the tax increases when the market is trading at all-time highs, because this is bad news. It will contract the multiples. It will shrink margins. You don't price in negative news when you're trading at all-time highs. Matter of fact, you're not pricing them in. Now, if the market was down 10 to 20%, then perhaps the impact of tax increases is already priced in. So I hope this is clear. When the market is trading higher, it is pricing in good news. If the market is down significantly, then it is pricing in bad news. When it comes to inflation, it's a little complicated because inflation is good for certain stocks, but it is bad for others. For example, if inflation continues to rise higher, take a look at the real estate sector of the market. It is not trading at elevated levels, so perhaps that the real estate sector of the market is not pricing in the good news of inflation, because inflation is good for real estate values. Different story for the Nasdaq, the high multiple names, because when inflation rises higher, interest rates rise higher, and therefore contracting the present value of future earnings. So take a look at the Nasdaq, the high multiple names. If they are trading at elevated levels, all-time highs, then perhaps they're not pricing in inflation, because inflation is bad news for the Nasdaq and the high multiple names. Anyways, what do we have on the earnings calendar for tomorrow? We have two important names, Union Pacific and Intel. Union Pacific rallied higher on the heels of Kansas Southern earnings, so perhaps they're already priced in the good news. You see how it works? Regardless, I would love to see a sell-off in Union Pacific because it is a bullet stock. The increase in commodity prices, whether it's oil, grains, doesn't matter. Union Pacific could also increase the fees they charge for transporting these goods, and the producers can easily afford to pay the extra charge. Inflation is good for Union Pacific. What about Intel? It's a value name. It's been rallying higher since the beginning of the year, over 20% rally. Have we priced in the good news? What matters is what Intel's management will say. Number one, you have to address the fact that NVIDIA is coming after you in the CPU unit. You have to address the fact that Apple is producing their own chips in their own products, the iMac, for example. So what will Intel business be in the CPU arena? Are they going to start selling hot dogs? Because their business is being squeezed in from every single corner. Second, we have to hear more about their foundry plans. They talked about building a big factory to manufacture chips. What are the updates? And will Intel eat up the cost for building these factories, or will they get relief and help from the federal government? And if that is the case, then that will be a strong tailwind for Intel shares to rally higher. Anyways, that's all I got for you tonight, and I will talk to you again tomorrow.